You've probably been told that renting is throwing money away, that buying is always better, that you're just paying someone else's mortgage when you rent. That advice has convinced millions of people to buy homes before they were ready. And it has cost them. By the end of this video, you'll know the real math behind both options, the hidden costs of buying that nobody talks about, and exactly how to figure out which one is actually the right move for you right now. Let's kill this one first. Yes, your rent payment builds no equity, but your mortgage payment in the early years barely does either. On a 30-year mortgage, the majority of your early payments go toward interest, not principal. In the first year of a $400,000 mortgage at 7%, you'd pay roughly $27,000 in interest and build only about $4,000 in equity. That interest payment? Also gone. Also not building equity. Renting is not throwing money away. You're paying for a place to live, just like a mortgage payment pays for a place to live. The difference is what else comes with each option. This is where most people get blindsided. The mortgage payment is just the beginning. Down payment, typically 3% to 20% of the purchase price. On a $400,000 home, that's $12,000 to $80,000 out of pocket before you move in. Closing costs, usually 2% to 5% of the loan amount. On that same home, add another $8,000 to $20,000 at signing. Property taxes varies by location, but the national average is around 1% of the home's value per year. That's $4,000 a year on a $400,000 home. Homeowner's insurance, roughly $1,500 to $2,000 per year on average. Maintenance and repairs. The standard rule is 1% of the home's value per year. On a $400,000 home, budget $4,000 annually. And in practice, years with a new roof or HVAC replacement will cost significantly more. PMI. If you put down less than 20%, you'll pay private mortgage insurance, typically 0.5% to 1.5% of the loan per year, until you hit 20% equity. Add it up, and the true monthly cost of owning is often $500 to $1,000 more than the mortgage payment alone. That gap catches people off guard. Rent. Renter's insurance, usually $15 to $30 a month. That's mostly it. No surprise repair bills, no property tax, no PMI. When something breaks, you call the landlord. Your cash stays liquid and your risk exposure is low. The trade-off is that you're not building equity, you don't have control over your space, and your rent can go up at renewal. Before you buy a home, add up these numbers nobody puts in the listing. Down payment, up to 20% of the purchase price. Closing costs, another 2% to 5%. Property taxes, roughly 1% of the home's value every year. Maintenance, another 1% per year. Homeowner's insurance, around $1,500 to $2,000 a year. On a $400,000 home, you're looking at up to $100,000 just to close the deal, and close to $10,000 per year in costs on top of the mortgage. More if you're paying PMI. Buying can absolutely be the right move, but go in knowing the full number, not just the monthly payment. Here's the framework that actually matters. How long do you plan to stay? Buying comes with massive upfront costs, down payment, closing costs, moving expenses. Those costs only make sense if you're in the home long enough to recoup them through equity and appreciation. The general rule is if you're staying for less than 5 years, renting is almost always the smarter financial move. If you're staying 7 years or more, buying usually wins. The break-even point, where buying becomes cheaper than renting on a cumulative basis, typically falls between 4 and 7 years, depending on your market, your mortgage rate, and local appreciation rates. Below that threshold, the transaction costs of buying eat your gains. If there's any real chance you're moving for a job, a relationship, or just life being unpredictable in the next few years, renting keeps your options open without costing you tens of thousands in transaction fees. Here's what the buy is always better crowd leaves out. That $60,000 down payment sitting in a home isn't working for you the same way it could be in the market. Historically, The S&P 500 has returned around 7% to 10% annually after inflation. Real estate appreciation nationally averages around 3% to 4% per year. And that's before you subtract taxes, maintenance, and insurance. That doesn't mean renting is always the right call. Home equity is forced savings, and most people are better at building it than they are at consistently investing. But the math is not as one-sided as the conventional wisdom suggests. Buying makes sense when you're staying put for at least 5 to 7 years. You have a stable income. You have enough saved for a down payment and an emergency fund, not one or the other. And your monthly ownership costs aren't more than 28% to 30% of your gross income. It also matters what market you're in. In some cities, buying is clearly cheaper than renting on a monthly basis. In others, especially high cost of living areas, renting is significantly cheaper, and the gap in monthly costs can be invested to outpace home appreciation. Run the numbers for your specific situation. The New York Times has a free rent versus buy calculator that accounts for all the real costs. Use it before you make any decisions. Renting is not failure, and buying is not automatically winning. The right answer depends on how long you're staying, what the real costs are in your market, and where you are financially right now. Don't let the throwing money away guilt push you into one of the biggest financial decisions of your life before the timing is actually right. Next up, we're covering something a lot of people dread: how to buy a car without getting ripped off. Dealer markups, financing traps, and what to do before you ever set foot on a lot. Subscribe so you don't miss it.